Evergrande carried more than $300 billion in liabilities. It was one of the largest property developers in the world. In 2021, it stopped meeting its obligations. The collapse was not caused by disappearing housing demand. It was caused by a financing model dependent on perpetual expansion. The company borrowed aggressively. It pre-sold apartments before construction. It rolled over debt with new debt. Growth masked leverage. Cash inflows funded prior obligations. Confidence sustained refinancing. When regulators tightened borrowing rules, liquidity tightened. When property sales slowed, cash flow weakened. When refinancing channels narrowed, debt became immediate. The crisis was not sudden. It was leverage meeting policy constraint inside a property-driven financial system.
Evergrande was founded in 1996. It began as a regional property developer in southern China. The company focused on large-scale residential projects. Urbanization supported rapid housing demand. Population migration increased apartment sales. Credit availability expanded alongside growth. Local governments relied on land sales revenue. Developers competed for scale. Evergrande pursued aggressive land acquisition. It targeted secondary and tertiary cities. Projects were designed for high density. Construction timelines were compressed. Sales cycles were accelerated. Capital turnover became a priority metric. Revenue recognition relied on project completion. Pre-sales generated early cash inflows. Expansion was geographically diversified. Brand visibility increased nationally. Marketing emphasized scale and reliability. The company moved into hundreds of cities. Total contracted sales expanded annually. Reported revenue grew consistently. Asset values rose with land appreciation. Balance sheet size increased. Borrowing capacity expanded with valuation. Investor confidence strengthened. Domestic banks extended credit lines. Offshore bond markets provided additional funding. Equity markets supported capital raises. Market capitalization increased. Corporate structure became layered. Subsidiaries managed regional projects. Debt was distributed across entities. Financial statements reflected asset growth. Liabilities increased alongside expansion. Cash flow appeared sufficient during growth cycles. Land reserves were reported as strategic assets. Project pipeline volume expanded. Construction workforce scaled upward. Cranes became constant features of skylines. Housing demand appeared durable. Policy environment initially supported development. Credit conditions remained accommodative. Sales velocity reinforced expansion plans. Each completed project financed the next. Scale reduced per-unit overhead costs. Operating margins appeared stable. The model depended on continued turnover. Growth became embedded in the structure. Structural takeaway. Expansion architecture embedded leverage within operating growth.
Evergrande relied heavily on the pre-sales financing model. Apartments were sold before construction was completed. Buyers provided deposits and staged payments. These payments became immediate working capital. Pre-sales reduced the need for upfront equity. Cash was received before delivery of assets. Construction was funded by customer advances. Revenue recognition occurred later in the cycle. Accounting separated cash receipt from profit realization. The model improved apparent liquidity. High turnover enabled rapid capital recycling. New projects were launched before prior projects were delivered. Pre-sales proceeds were not isolated to individual sites. Funds were pooled across developments. Cash from one project financed another. This created interdependence across regions. Project completion timelines became critical. Any delay affected multiple obligations. Buyer confidence was essential to sustain inflows. Marketing campaigns emphasized delivery certainty. Scale reinforced buyer trust. Banks considered pre-sales as evidence of demand. Land acquisitions were justified by forward contracts. Leverage increased as presales volumes expanded. Short-term liabilities grew with deposits. Construction obligations accumulated. The balance sheet reflected large contract liabilities. Liquidity depended on continuous new sales. Sales velocity became the primary stabilizer. Economic slowdown directly reduced inflows. Policy adjustments influenced buyer sentiment. Mortgage availability affected presales momentum. Speculative purchases amplified cycles. Inventory turnover rates masked funding risk. Cash balances fluctuated with launch schedules. Capital discipline relied on market continuity. Developments were launched in rapid succession. Operational complexity increased. Regional management required coordination. Delivery risk multiplied across sites. Quality control pressures intensified. Construction contractors were paid from pooled funds. Supplier credit terms shortened during stress. The presales model amplified expansion speed. It also amplified exposure to slowdown. Revenue visibility was high during boom periods. Liquidity visibility was dependent on forward demand. Growth and funding became inseparable. Presales were both product and financing mechanism. When sales were strong, the structure appeared resilient. When sales slowed, liquidity tightened immediately. Structural takeaway. Presales converted customer deposits into systemic liquidity dependence.
Expansion accelerated after 2009. Credit conditions in China remained accommodative. Property prices appreciated across major cities. Evergrande increased its land bank aggressively. Land purchases were often financed with borrowed capital. Short-term debt supported long-term assets. Total liabilities expanded year after year. By 2021, liabilities exceeded $300 billion. Onshore bank loans formed a large portion. Offshore dollar-denominated bonds added exposure. Trust financing vehicles supplemented borrowing. Supplier financing extended payable cycles. Commercial paper circulated within the ecosystem. Debt maturity schedules became layered. Rollover risk increased with scale. Interest expense rose alongside principal. Cash flow statements reflected heavy financing activity. Operating cash flow fluctuated with presales. Investment cash flow remained consistently negative. Financing cash flow filled the gap. Leverage ratios moved upward. Net gearing became elevated. Asset valuations supported collateral assumptions. Land reserves were marked at market expectations. Future price appreciation justified borrowing. Expansion targets became annualized benchmarks. Management incentives aligned with sales volume. Scale was equated with resilience. Debt was framed as growth capital. Equity issuance became less frequent than borrowing. Credit markets remained open. Ratings agencies monitored liquidity metrics. Covenants required compliance thresholds. Balance sheet complexity increased. Intercompany guarantees linked subsidiaries. Off-balance sheet exposures existed in joint ventures. Contingent liabilities accumulated. Capital allocation favored expansion over deleveraging. Refinancing cycles shortened. Short-term obligations required constant access to markets. Investor appetite remained strong during growth. Bond yields reflected perceived systemic support. Implicit assumptions reduced risk pricing. Growth narrative reinforced credit availability. Financial engineering supported liquidity optics. Reported assets expanded in parallel with liabilities. Liquidity buffers narrowed relative to obligations. The structure depended on uninterrupted credit access. Debt was no longer supplemental. It became foundational to operations. Structural takeaway.
Debt-fueled expansion transformed leverage from tool to structural necessity.
As expansion continued, Evergrande diversified beyond core housing. The company invested in electric vehicles. It entered wealth management products. It financed theme parks and cultural tourism projects. It acquired stakes in healthcare ventures. Capital was allocated across non-core segments. These initiatives required additional funding. Many projects generated limited immediate cash flow. Return timelines extended beyond property cycles. Management attention became dispersed. Capital expenditures increased. Borrowing supported diversification. Investor communication emphasized ecosystem strategy. Conglomerate positioning was presented as risk mitigation. Operational complexity expanded. Subsidiaries multiplied across sectors. Financial reporting became more layered. Internal capital transfers increased. Cash allocation decisions became centralized. Non-core investments reduced liquidity flexibility. Working capital was stretched across initiatives. Debt obligations remained fixed. Interest payments required predictable inflows. Diversification did not reduce leverage. It increased capital intensity. The property segment still generated primary cash flow. Non-core units depended on internal funding. Asset disposals were limited during growth. Valuations were based on projected scale. Market conditions influenced asset pricing assumptions. Liquidity remained tied to property presales. Balance sheet expansion masked allocation strain. Cash reserves appeared large in aggregate. Short-term obligations remained substantial. Project commitments accumulated. Supplier payment cycles lengthened. Wealth management products were sold to retail investors. Some products financed internal operations. Short-term instruments funded long-term assets. Maturity mismatches widened. Risk dispersion increased. Cross-entity guarantees persisted. Regulatory oversight varied across segments. Corporate governance complexity increased. Capital markets evaluated consolidated exposure. Diversification required continued expansion. Deleveraging was deferred. Growth targets remained unchanged. Liquidity buffers were not structurally strengthened. The company became capital-intensive across sectors. Expansion commitments limited strategic flexibility. Structural takeaway: diversification amplified capital demands without reducing leverage dependence.
Evergrande's structure depended on continuous refinancing. Debt maturities were staggered across months and years. Short-term obligations required regular rollover. Onshore banks renewed credit under stable conditions. Offshore bond markets absorbed new issuance. Trust financing provided bridge liquidity. Commercial paper extended payment timelines. Supplier credit filled temporary gaps. Interest payments were met through new borrowing. Principal repayments were often refinanced. Cash reserves alone were insufficient to retire debt. Liquidity planning assumed open capital markets. Credit lines functioned as operational infrastructure. Rating stability supported investor participation. Bond yields reflected refinancing confidence. Maturity walls were managed through issuance cycles. Each quarter required market access. Market sentiment directly affected funding costs. Sales slowdowns reduced operating inflows. Refinancing replaced internal cash generation. Debt service coverage depended on new capital. Covenant thresholds required compliance monitoring. Intercompany guarantees linked obligations. Liquidity buffers narrowed during weak sales periods. Bond investors monitored leverage ratios. Trust products required repayment confidence. Offshore investors relied on reported transparency. Currency exposure introduced exchange risk. Dollar-denominated debt required external confidence. Domestic liquidity conditions influenced rollover capacity. Regulatory communication affected market perception. Presales provided partial liquidity relief. Construction commitments required steady disbursement. Delayed payments increased supplier pressure. Working capital cycles tightened. Refinancing cycles shortened as maturities approached. Yield spreads widened under stress. Access to new issuance became conditional. Creditors reassessed counterparty risk. Investor appetite fluctuated with policy signals. Debt became self-perpetuating. New obligations replaced old ones. Liquidity stress emerged when issuance slowed. Refinancing was no longer optional. It became structurally mandatory. The model required uninterrupted confidence. Without rollover, obligations became immediate. Cash inflows alone could not stabilize leverage. Refinancing dependency exposed structural fragility. Structural takeaway? Continuous rollover converted market confidence into a structural survival requirement.
In 2020, regulators introduced borrowing constraints. The policy became known as the 3 red lines. Developers were evaluated on leverage thresholds. Liability to asset ratios were capped. Net gearing ratios were limited. Cash to short-term debt coverage was required. Companies breaching thresholds faced borrowing restrictions. Evergrande exceeded multiple limits. Access to incremental debt tightened. Refinancing capacity was constrained. The model assumed credit elasticity. Policy introduced credit discipline. Land acquisition pace slowed. New project launches were scrutinized. Bond issuance windows narrowed. Investor risk perception adjusted. Liquidity buffers were tested. Debt reduction targets were announced. Asset sales were considered. Valuation expectations softened. Pre-sales momentum decelerated. Mortgage approvals tightened in some regions. Cash inflows became less predictable. Trust financing availability declined. Short-term instruments matured without replacement. Interest expense remained constant. Principal schedules approached maturity dates. Supplier payment cycles extended. Wealth management obligations required settlement. Confidence began to erode gradually. Credit spreads widened. Bond prices declined in secondary markets. Ratings outlooks shifted. Market access became selective. Domestic banks reassessed exposure. Offshore investors demanded higher yields. Intercompany guarantees amplified pressure. Cash reserves were allocated strategically. Project completion became prioritized. Non-core investments were reassessed. Cost controls intensified. Liquidity planning shifted to contingency mode. Maturity walls became visible in public filings. Transparency increased under regulatory review. Refinancing timelines compressed. Market sentiment became cautious. The company faced policy-imposed leverage ceilings. Growth was no longer unconstrained. Structural dependency on expansion was exposed. Regulatory constraint converted leverage into visible stress. Structural takeaway: policy-imposed leverage limits exposed the fragility of growth-dependent financing. By early 2021, liquidity pressure became observable. Pre-sales growth slowed across multiple regions. Buyer sentiment weakened under policy tightening. Cash inflows declined sequentially. Construction obligations remained fixed. Short-term maturities approached settlement dates. Refinancing options narrowed. Offshore bond issuance slowed materially. Trust financing volumes contracted. Supplier payment delays increased. Contractors reported extended receivable cycles. Wealth management products reached maturity. Redemption requests increased. Cash allocation became prioritized toward project completion. Non-core expenditures were reduced. Asset disposal discussions intensified. Valuations were marked below prior expectations. Bond yields rose sharply. Secondary market prices implied distress. Credit default risk was repriced.
Ratings agencies downgraded outlooks. Covenant pressure increased. Intercompany transfers became more frequent. Liquidity buffers eroded further. Debt service required selective prioritization. Interest payments were delayed in some cases. Offshore investors monitored grace periods. Confidence declined incrementally. Equity market capitalization contracted. Market access became conditional on restructuring signals. Management communication emphasized stability. Regulators monitored systemic exposure. Bank exposure reviews intensified. Mortgage disbursement cycles slowed. Cash conversion timelines extended. Working capital strain widened. Cross-border funding flows tightened. Currency volatility added pressure. Short-term liabilities exceeded available liquidity. Negotiations with creditors began informally. Maturity extensions were discussed. Bondholder committees organized. Market perception shifted from growth to solvency risk. Liquidity stress transitioned from temporary to structural. Cash inflows could not offset obligations. Refinancing channels were largely inaccessible. Debt that once rolled forward now accumulated. The structure required uninterrupted expansion. Expansion had slowed materially. Structural takeaway. When refinancing halted, accumulated leverage converted into immediate liquidity stress.
In mid-2021, bond payment deadlines approached. Interest obligations required scheduled settlement. Cash balances were insufficient for full coverage. Grace periods were invoked on certain offshore bonds. Market participants monitored payment confirmations. Bond prices declined further in secondary trading. Credit spreads widened significantly. Missed payments signaled liquidity breakdown. Cross-default provisions became relevant. Contractual triggers intensified creditor scrutiny. Negotiations with bondholders accelerated. Offshore investors coordinated through committees. Onshore obligations required separate treatment. Regulatory guidance influenced payment sequencing. Project completion remained prioritized domestically. Cash allocation favored construction continuity. Offshore creditors faced delayed settlements. Trust products required restructuring discussions. Wealth management investors sought repayment clarity. Supplier claims accumulated. Contractors adjusted exposure. Ratings agencies issued further downgrades. Equity trading volatility increased. Maturity extensions were proposed. Asset sales were evaluated under stressed pricing. Valuation discounts reflected urgency. Liquidity forecasts shortened to weeks. Confidence erosion reduced buyer activity. Pre-sales volumes declined further. Mortgage approvals remained cautious. Cash inflows compressed. Debt that had been long dated became immediate. Refinancing windows were effectively closed. Interest accrual continued regardless of payment delay. Legal advisors were engaged. Restructuring frameworks were drafted. Offshore restructuring required multi-jurisdiction coordination. Domestic policy objectives intensified sequencing. Systemic exposure assessments intensified. Banks evaluated collateral coverage. Shadow financing vehicles reduced participation. Capital markets priced default probability. Bondholders anticipated recovery scenarios. Equity investors repriced residual value. Operational continuity relied on regulatory oversight. Liquidity triage replaced expansion planning. The collapse was procedural, not instantaneous. It unfolded through missed obligations. Structural fragility transitioned into formal default risk. Following payment stress, restructuring became central. Management initiated formal negotiations with creditors.
Advisors were appointed to structure proposals. Offshore bondholders formed organized committees. Onshore stakeholders required parallel discussions. Regulatory authorities monitored restructuring progress. Liquidity preservation became the primary objective. Asset sales were prioritized under supervision. Non-core divisions were targeted for disposal. Valuations reflected distressed conditions. Buyer demand was selective. Proceeds were insufficient to cover total liabilities. Debt restructuring frameworks considered maturity extensions. Interest deferrals were proposed. Haircut scenarios were evaluated. Conversion to equity was discussed. Cross-border legal coordination was required. Different creditor classes held varying priorities. Secured lenders negotiated recovery positioning. Unsecured bondholders assessed expected returns. Domestic banks aligned with policy guidance. Project completion remained a social priority. Cash allocation favored residential delivery. Offshore recoveries were subordinated in practice. Transparency improved under restructuring disclosures. Liquidity projections were revised repeatedly. Market capitalization contracted substantially. Equity dilution became probable. Confidence among buyers remained fragile. Pre-sales did not return to prior velocity. Contract liabilities persisted on balance sheets. Construction progress slowed selectively. Suppliers renegotiated payment terms. Contingent liabilities were reassessed. Asset impairment charges accumulated. Balance sheet equity turned negative under certain estimates. Restructuring timelines extended. Legal proceedings varied by jurisdiction. Global investors tracked recovery ratios. Rating agencies reflected default classifications. Market capitals treated debt as distressed. Policy intervention focused on systemic stability. Resolution required coordination across ministries. The company's operating footprint contracted. Growth strategy was abandoned. Liquidity was allocated defensively. Debt obligations exceeded realizable asset values. Restructuring sought order rather than expansion. The leverage cycle had reversed. Structural takeaway. Restructuring acknowledged that asset liquidation could not offset accumulated leverage. As restructuring progressed, systemic exposure became a central concern. Evergrande's liabilities exceeded $300 billion. The company operated across hundreds of cities. Millions of homebuyers awaited project completion. Banks held direct loan exposure. Trust companies held structured claims. Offshore investors held dollar-denominated bonds. Suppliers carried unpaid receivables. Contractors depended on settlement schedules. Local governments relied on land-related revenue. Property represented a significant share of economic activity. Housing wealth influenced household balance sheets. Mortgage performance depended on delivery confidence. Financial institutions evaluated contagion risk. Liquidity stress in one developer affected peers. Bond spreads widened across the sector. Equity valuations declined for other developers. Regulators monitored systemic liquidity. Policy responses aimed to prevent disorderly collapse. Credit conditions were adjusted selectively. Project completion funds were ring-fenced in some cases. Moral hazard concerns limited blanket guarantees. Market discipline was partially preserved. Other developers faced similar leverage structures. Pre-sales models were common across the sector. Refinancing dependence was not isolated. Growth-driven leverage was systemic. Investor risk perception shifted broadly. Capital flowed more cautiously into property. Land auction activity declined. Housing price expectations softened. Foreign investor confidence weakened. Currency markets monitored exposure. Global asset managers reassessed emerging market risk. Credit rating downgrades extended beyond one firm. Policy recalibration sought controlled deleveraging. Stability objectives shaped intervention design. Financial system buffers were tested. Domestic banks adjusted lending standards. Trust financing volumes contracted. Property-linked products faced scrutiny. The sector entered structural adjustment. Evergrande became a reference case. The crisis demonstrated scale does not ensure resilience. Leverage at systemic levels amplifies stress transmission. Contagion risk required coordinated containment. Expansion-driven funding models were reassessed industry-wide. Structural takeaway. When leverage structures are systemic, stress at one node transmits across the network. Evergrande's collapse followed a structural sequence. The company was founded in 1996. It expanded through rapid land acquisition. Pre-sales converted buyers into liquidity providers. Debt financed expansion across hundreds of cities. Liabilities exceeded $300 billion by 2021. Refinancing replaced internal cash generation. Growth masked rising leverage. Diversification increased capital intensity. Short-term funding supported long-term assets. Intercompany guarantees linked obligations. The balance sheet expanded faster than retained earnings. Policy constraints limited incremental borrowing. The three red lines imposed leverage ceilings. Pre-sales slowed under tightening conditions. Cash inflows declined sequentially. Refinancing channels narrowed materially. Bond maturities became immediate obligations. Liquidity buffers proved insufficient. Missed payments formalized default risk. Restructuring acknowledged asset shortfall. Asset disposals could not offset total liabilities. Systemic exposure required policy coordination. Project completion was prioritized over creditor recovery. Offshore investors absorbed extended losses. Domestic stability shaped restructuring sequencing. The property sector entered controlled deleveraging. Capital markets repriced risk broadly. Leverage, once perceived as manageable, became destabilizing. Confidence-dependent funding models proved fragile. Growth-dependent leverage failed under constraint. Scale did not protect against liquidity stress. Balance sheet opacity delayed recognition. Complex corporate structure diffused accountability. Refinancing cycles compressed under scrutiny. Debt service depended on continuous expansion. When expansion slowed, obligations accumulated. Liquidity planning assumed perpetual market access. Market access was conditional on confidence. Confidence eroded under policy tightening. Stress revealed embedded structural imbalance. Accounting presentation could not alter cash realities. Governance structures could delay but not prevent recognition. Corporate collapse unfolded through mechanical constraints. The outcome reflected structure interacting with stress. Leverage built on perpetual growth fails when growth is constrained. Corporate collapse is structure meeting stress. Structural takeaway. Accounting or governance structure can delay recognition of stress, but it cannot eliminate it. Corporate collapse is structure meeting stress.